Three.
Hello everyone. Today our group is here to discuss on the topic Franklin Templeton debt fund wind up 26,000 crore frozen overnight. On 23rd April 2020, Franklin Templeton shocked Indian investors by winding up 6 debt mutual fund schemes, freezing more than 26,000 crore overnight. For many retail investors, debt funds were considered almost as safe as fixed deposits. This sudden decision broke that perception and triggered panic across India's fixed income market. This case matters because it exposed how credit risk and liquidity risk can quietly build up inside debt mutual funds, especially during stressed market conditions.
Talking about the company, product and the Indian context of the issue, Franklin Templeton is a global asset management company which has been operating in India since 1996, and it offers both equity and debt mutual fund schemes. The 6 wound-up schemes include credit risk and income-oriented debt funds, which have promised higher returns than the general traditional fixed deposits. In India, debt mutual funds are widely used by conservative investors for capital preservation. However, to generate higher yields, these schemes invested heavily in corporate bonds and rather than the government securities.
Between 2018 and 19, these funds steadily increased exposure to lower rated and privately placed corporate bonds. When COVID-19 struck in early 2020, economic activity slowed down and our Indian bond market faced a severe liquidity crunch. As the fear increased, investors rushed to redeem their investment. But since the bonds were illiquid, selling them would have resulted in heavy losses.
Talking about credit risk and credit spread, to understand this crisis, the first key concept is credit risk. And to lower, the rated bonds offer higher yields because they carry a higher probability of default, and during the normal times, the strategy increases the returns. However, during the crisis, investors demanded much higher risk premiums. Credit spread widened sharply, bonds prices fell, and the net asset value of these schemes declined rapidly.
The second important concept is illiquidity risk. These were open-ended mutual funds that allowed daily redemption, but the underlying corporate bonds were liquid and could not be sold easily in stretched markets. This liquidity mismatch meant that honoring redemptions would force distress selling. To protect remaining investors, Franklin Templeton decided to wind up all the schemes.
The impact of this was that more than 3 lakh investors were affected by this decision. SEBI, RBI and the Supreme Court intervened, which led to court-monitored asset recovery and regulatory scrutiny. This episode led to stricter valuation norms, liquidity stress testing, and greater transparency requirements for the Indian debt mutual funds.
For investors, this case highlights the importance of not chasing yield and carefully evaluating credit quality. For fund house, robust liquidity management and conservative credit selections are essential. For regulators, continuous monitoring and tighter disclosure norms are critical.
So finally, in conclusion, the Franklin Templeton crisis clearly proves that debt mutual funds are not risk-free. In fixed income investing, credit quality and liquidity matter far more than short-term returns.
That's all from our side. Thank you so much.